All right, let's just get going. How you guys all doing? I hope everyone's doing well and staying safe. My name is Robbie Bhathal. I'm a co-founder and CEO of Brightflow AI. Our hope in these webinars is just to, educate small business owners on the various intricacies of finance. And this one is really around how to assess your business and how to scale your business beyond your income statement. And so appreciate you guys taking the time and appreciate your joining us for this call. The call will be with both myself and Matt, and we'll introduce ourselves in a little bit. So before we start, just want to give you guys a little background on Brightflow and kind of who we are. We're a software company. We're based out in Oakland, California. Our kind of vision is to democratize finance. We do this by integrating all financial data that you get from whether it's offline, online with Square, or mainly right now with online storefronts, Shopify, Amazon, and provide a really simple, seamless, automated view into finance. Think of it as a financial dashboard. Look into how much you're valued is your customer, how much your runway is, things like that, where you would spend a lot of times in Excel. We've kind of made it a mission to make it easily accessible. And the things that big companies invest in, we want to bring it to smaller companies. We are about to launch in Shopify in the next week. Thank you again for the time, and that's who we are. So a little bit about myself. Again, like I said, my name is Rob Bhathal. I'm the CEO of Brightflow AI. Prior to Brightflow, I was the CEO of a company and raised a little bit of capital through it, and it was a travel company. I also work as interim CFO of a couple companies, specifically e-commerce brands, and help them scale, whether it's through AR factoring or just financing. And I've been in finance since I graduated from undergrad, and met our head of product, Matt Acalin, actually at business school. And so my experience has been, I've taught class at Berkeley in financial statement analysis. I live and breathe finance, and kind of I'm hoping to bring that kind of knowledge to as many people as they can in an easy way. So I'll let Matt introduce himself as well.
There we go.
There you go.
Hey, I'm Matt Acalin, head of product, and I started my background is I started my career out at General Electric, working with CFOs and corporate finance. So all of the painful things that I had to go through, I'm hoping to automate, as far as moving around numbers and generating financial statements and generating key metrics about the business and things like that. So spent 2 years at GE. Then I went on to a private equity firm called Summit Partners, where I invested in technology companies, did a lot of interesting deal modeling and sourcing, even inside sales to try to source investments, and then a lot of financial analysis for our portfolio companies and companies that were prospective investments. Then I went to business school at Berkeley and kind of shifted into technology. I was a product manager at Upwork for about 3 years. Then I managed a startup. I did some work in corporate venture capital focused on software. And now I am the head of product here at Brightflow AI. And I kind of started my career in finance, but then have been shifting more closer towards technology for a while. And it's an interesting, exciting opportunity to kind of take the job I used to do and simplify it and making it accessible for people who normally would only have access to these tools at an enterprise level, right? And bringing them kind of to the small business. So it's exciting. I'm in a role where I'm applying kind of this technology expertise that I'm building to solve problems that I used to handle in Excel. And now we're kind of disrupting new ways, better tools to do that type of analysis.
Thanks, man. So just a little agenda. We haven't done it formally, but I'll go through some background. We have a Q&A. You guys can answer any questions you want. I'll try to answer it at the end. The material can be dense. Obviously, our goal is to make it as easy and understandable as possible. And our software is hopefully going to replace a lot of this stuff, but it kind of give you guys the ammo to make decisions in specifically around the times like now, how to invest cash, what's important to look at, and hope is beneficial, and happy to answer questions at the end. But feel free to post questions as you guys are going through. So most of the times when most business look at their, most owners and most companies look at their business, especially in the small business, you're looking at this simple P&L view. It's kind of the first page you see in QuickBooks. It's kind of what everyone assumes is a way to run their business, is optimize it on profit and loss. But that is actually, it has really good, it can be very beneficial to understand how profitable your business is from like a unit perspective, or the health of your business. And the P&L can be great. I mean, it's obviously great for taxes, but not all the time what you optimize for taxes are really good for your own business. And one of the big ways is around cash. So P&L doesn't give you the insights you need to understand how money flows in your business. And the reason why that's important is because cash is like the lifeline of any business. Alan Sugar, who was the founder of Seagate, once said that cash is more important than your mother. It is also 82% of businesses fail, not because of running out of cash. So it's not, it's kind of I just don't have any money left. It's really the experiencing cash flow problems. So it's timing of cash, when revenue gets into your business. You sell something online, it takes 3 business days to come in. You sell something on Amazon, it takes 15 to 21 business days to come into your cash balance sheet. Buy something, are you buying it on credit, cash? And all those things can be expensed and recognized as revenue, but it's really, it masks what really is happening in your business, which is cash. Money in, money out is kind of the lifeline of a business, and it's hard to sift through. And when it comes down to P&L. And so this is an example, one really simple example that we think about when you think about income statement, of how this kind of misalignment happens. Like, if you look at your business and, you are profitable, you made $1 million in revenue in 2019, you made a net profit of 200,000. Sounds great. I'm profitable. But then if you look at your cash balance at the end of the year, you might actually have no cash, even though you made a profit. And that money might be coming a month later, might coming 2 months later. But if you just stared at just your P&L, you would assume that you have that money in your bank, or it might not come until some certain time. And so that's where the two statements kind of, it can't be just looked at just independently. And so when looking at making your business decision on profit on P&L is great. The issue is that you mask a lot of the cash, like we talked about, and you can actually have a worse position than you think. So sometimes, like, why do my sales go down, but my sales are going up, but my cash is going down? That's because of timing of cash. And that's what we're talking about, is the issues with just relying on your income statement. And there's always a method to the madness, and it's not to say that the way the P&L works is not great. I mean, obviously we look at everything holistically as a business, your balance sheet, your cash flow. It's just when you're running a small business, like, you can optimize your business in multiple ways. You want to make sure your business is profitable. You're making gross profit. You're expensing the right way to get the best in terms of tax savings. You can amortize expenses, so you're not, you can do many ways to manipulate kind of the accrual method, which is considered a generally accepted accounting principle, and which is great for again, accounting and taxes. But when people think about what a CFO does, accounting and tax is just one part of it. And there's also the finance part, which is how to extend cash. Like, how do I know when to purchase? And that's where you can do your P&L on a cash basis, but it's really hard. It's hard because you're not optimizing for taxes. It's hard because cash doesn't come in at the same time. And so you have to update all your invoices and have to have systems to do it. If you're selling online versus retailers, everyone's got different terms. So it's really hard to manage cash basis. So most people do P&L with accountants on accrual basis, and then they build Excel models or understand their own cash. And that's where that's why it's difficult. And that's why even QuickBooks isn't built for it. They have this new tool that allows you to see some cash forecast, but it's really minimal visibility on historical. And so this is why when you run your own business, it's great to just like model in the cash component and ask yourself, what things can I do to make more, like, to increase cash now and decrease cash out? Like, so increase cash coming in and decrease cash going out. Push out accounts payables and stuff. Those are the things that we are talking about here. So another example I just want to give is, I'm going to give a couple of really high level examples, is like, let's say you want to run ads. And so you think about running ads and you run it on Google. and you go to Google and you're like, man, I have $1,000 and I want to run ads, but that's money going out the door right now. And so if you think about it from a P&L perspective and you run that $1,000, that expense is going to hit right up front. However, Google allows you to run ads on credit cards. There's regular credit cards. So you don't have to run in an ACH. So if you're running on a credit card, even if you are expensing cash now, you're not paying the bill for marketing until next month. So you basically created a cash, like a float. So you're obviously going to have to pay the bill, but if you're able to get more customers now, that will eventually pay the money that you need to pay for expenses. And then it's like, well, if I'm paying 30-day credit cards, are there any other credit cards that do 60-day payables? And you can see how that changing from cash out and thinking about that as a marketing expense of cash, you can run it on credit and you can run it on credit cards out. And what that does is that gives you more cash up front to actually reinvest in your business. So you're not making a decision on, oh man, I have to have $1,000 in my bank account to run this deal. No, you can spend $1,000 and yeah, you're going to have to test it out. And that's where big companies really get leverage, is by doing it and extending that cash out, is that you can do it. Any small business can do it. They can run Google ads and Facebook ads on credit cards. And so you're just extending that cash out. And so that's one great example of a way to not run your business on your P&L, but run it on a way like, how do I, keep cash in my bank account, push cash out, and capture revenue at the same time? It's running ads, but running ads on credit, not running ads on cash and ACH. Another example is a really good one is retail. It's the other side. A lot of times revenue is recognized when it's sold into a distributor, sold into a retailer. So you get this, you sell into Target, you get excited. You're like, I got $1 million order from Target for my product, or I've got, a service contract that someone did for $100,000 and that's my revenue. And you put it in your P&L as a revenue in. But the problem is that service contract, or even that product being sold and Target getting it, even though you claim it as revenue, they're not paying you the cash up front. There's a Target sometimes there's 60 days out, 90 days out. Now, if you're waiting 90 days for your revenue and you have expenses every month, like payroll, like fixed expenses that are just going to hit every month, you might assume on your P&L that I've got money coming in, but in actuality, you don't have money coming in right now. You have money coming in 90 days. And so the way you can then assess your business on that way is be like, how do I get the money in 90 days now? And so there's things like AR factoring, there's AR lines of credit. There's a lot of tools like neobanks that are coming out that are doing this, and I'll talk about it next slide, but there's ways to do that. And the same goes with inventory purchasing. With that Target order, you're gonna have to purchase inventory. So how do I not purchase inventory, hundreds of $1,000s in inventory 3 months before I get acclaimed of revenue, and then I have to go and collect the cash. And so you can see how the cash cycle changes even though your revenue is coming right up front. And I think that's where being very cautious and being aware of that stuff and understanding how to leverage cash cycles can actually help you create working capital. And in essence, that's what the word working capital is capital that allows you to work your business. And so it's a term that most people don't think about, but it's as I call it, like a beautiful term, because it is really it's the cash that the cash that your business makes. It's not the profit, it's the cash that it generates, and how do you actually optimize that cash. And so you can do a lot more with that. So if the revenue comes up front, you can use that revenue to pay bills. If the revenue comes later, then you've got a problem where you're going to have to figure out how to get revenue up front. And so there's tools and places to go to get this stuff. And these are a couple of them. So so to manage your business through a market turbulence and to manage your cash and not your P&L, there's things to leverage you can do. One thing is you can leverage timing of cash to be in your favor, like I talked about. Amex Plum, someone told me when I first started my business about Amex Plum, and they were like, it's a 60-day payable. Like you get 1% back, but they don't let you pay. You don't have to pay the full balance until 60 days. Now that, in my mind, I was like, I have to raise money or I have to wait for someone to buy my stuff. Well, now I just have something where I can actually do revenue. I can do marketing and not have to pay for that for 60 days. And if I get revenue in the 60 days, I can use that revenue to pay for my marketing. So I'm timing the cash in my advantage. The other one is just negotiating with supplier concessions, talking about, working with alternative usage of cash, like things like AR factoring. So it's really leveraging cash for your timing. The other thing is in these times is like trimming the fat. So like curbing non-essential spending, renegotiating terms, and so those are the kind of the other things that you can do in this kind of turbulent markets is just like, how do I keep as much cash in my balance sheet and reinvest that? In the end, if you're holding cash in your company, you're thinking of investing it in your business that returns a higher return. So you want your business to grow. So you're not just taking the cash out of the business, you're putting it in. And so in these times where you're not sure, just trim fat. So one thing is leverage timing, 2 is trim fat, 3 is find alternative solutions of cash. And it's obviously traditional banks are tough. They're looking at 2 years historical data. They want a colonoscopy on your financials, but there's a lot of new types of businesses out there. Like Clearbank is a great example where if they take your Shopify data, they just give you like a line of credit for marketing expenses, and it's very low interest, like 2 to 3%. So things like that, where you're not using your own cash, but you can still test out marketing, and you can test out those things to gain revenue, and you're not really extending cash out. And then the last thing is things like SoFi are great too, where you can do like more lending, not just from traditional places. And the last one is really investing early. And so that comes down to finding ways to get cash and then reinvesting that cash in your business. And so I hope this kind of gives you an idea that, what we're talking about is your P&L is great and you always want to manage it, and it's not a replacement, but as you run your business, the accountants will handle that and just gives you a sanity check of like, am I making positive gross margin? Am I making positive margin as a whole? And that's a health, like that's just kind of the back end check. But as you get to these times of running your day-to-day business, what's more important is how do I keep more cash in my business and how do I extend my cash out? And that's like your number one thing. And so all these tools that we're saying allow you to do that and reinvest that timing, like the cash advantage, into your business. So like I said, Amex for credit cards or any of these kind of tools. So that's kind of an overview. I'm going to let Matt now dive into really granular level stuff that you can do. And some of them might be, some of this might be really dense. So please feel free to ask us questions afterwards. And obviously our own product is meant to replace a lot of the stuff, but until that time, we wanted to give you the tools. So Matt, go for it.
Great. Yeah, thanks, Robbie. So make sure I'm unmuted. So first, just building off what Robbie said, he talked a lot of different ways how you can leverage your working capital kind of to your advantage. And this is actually a snapshot of the outflows piece of our product that's being built. And as you can see, we have kind of the different line items of the outflows stacked up. So you've got your Facebook and Google marketing expenses, you've got your inventory costs, and then below that, we've structured different buckets, one for variable costs, one for fixed costs, just based on how they behave. One of the problems when dealing with your income statement is costs aren't bucketed that way. Nothing's labeled what's variable and what's fixed. And variable cost varies as you sell more products, and fixed costs, like base salaries, don't. So it's important to break those two things up. And then you can see, as a key feature, we've got days until cash there. So you can, as Robbie mentioned, negotiate terms for different marketing promotions, or especially for inventory cost. You can kind of see a breakout on the right of the slide, the box that really just shows the intuitive relationship between if it takes you 30 days to pay versus 60 days to pay, right? That's 100% of that coming through in month 2 versus 100% of it coming through in month 3. And that's cash that you can just use for other purposes. So it's very, very important to apply a cash delay to anything coming off your income statement as far as revenue and expenses, to just see really what the health of your business is, because you will go bankrupt if you don't do this and think this way. You can go to the next slide. So one of the questions is, why is working capital so important? Like, why do you want to save working capital? And there's different pieces of working capital that will draw cash. And when you can make leadway in one, it'll help you invest in the other. So I just wanted to walk through one example, and then I have a case study that involves this inventory for one of our clients. So if you just think about the cash cycle, right? If you look at your income statement, you're just going to see an income number and then a cost of goods. And that cost of goods represents the value of the inventory that you sold. But you purchased that inventory a really long time ago, and you had it in storage, right? So just walking through this timeline left to right, you buy the inventory, you've got your shipper, you got your supplier shipping time till you receive it, right? And typically the second that box is on the truck, it's your property, right? You're getting billed for it, right? Then it's in your inventory, right? Your initial cash outflow happens where you pay your inventory, that's your cash outflow. And then you wait, and eventually the customer buys it and your cash is received in the back end. And that kind of represents your cash cycle. Now, the big question here is, before we were dealing with expenses, and expenses, you have a delay. Well, here, inventory, you need to buy ahead of time, right? The inventory purchase lead time is really important for you to understand when you're going to need to spend cash to pump up your inventory. So if you go to the next slide, this is an example of one of our customers. And I couldn't show you all the information, but I took what I could, and you can kind of see how inventory plays into this. So at the top, you can see that typically inflows are delayed between 5 and 25 days, right? And that's represented here in the Amazon and Shopify line items, which are growing over time. And then at the bottom, you have total inflows. Now, if you look at total inflows, you think, okay, great. They have a seasonal business, right? They're 354 in January. They go down to 250, right, in April. And then they build back up and are at practically 500K in December, right? So then if you go to the chart below and look at how their cash balance moves, right, the light bars are the inflows and the dark bars are the outflows. And you could understand why cash might be going down as they're performing worse and getting less sales. But then as they get towards the end of the year, when sales really start to pick up, all of a sudden, 2 months beforehand, they had to start ordering all this inventory, right? And this is our actual customer back in January, puts this in our model, we spit this out, and they realize we're showing profitability, but we're going to go bankrupt in September, right? So what did they do? They went out and got a revolver. Now, side story on this, this business got a real big boost because of COVID. And so they established the revolver in June and actually had to draw on it in July, even earlier, because volume ramped up. So this is just one example where if you're looking at your income statement, it may show you as profitable, right? And you may making profitability. If you're a fast growing business and you're pumping money and cash to build your inventory levels, that's cash that's just going out the door. That is not going to show up on your income statement. That is very important for the financial health of your business to have a handle on. You can go to the next slide. That's all I had on that one. Okay, so this is the dense slide. So this is going to be 2 minutes. We're going to go through this. If we've talked to you about how important a cash delay is, and here is the reference. So we're going to send you the video after this. If you want to screenshot this, this will give you everything you need to know how to implement a cash delay in Excel. But I'm going to give you kind of the 90-second voiceover on it. Okay. So if you look at this first table, we've got accrual revenue at the top. You've got total, Amazon, and Shopify, right? And this is the accrual revenue, right? So for example, Shopify in July has almost 16,982 of revenue, right? And then if you look below it on that Shopify, I have a 60-day delay for how long until that turns into cash. So you can see how how this accrual number up top goes through this kind of middle piece and then ends up at the bottom as the cash flow numbers, right? So you can see revenue that happened in July shows up in September, right? And that's kind of how you want to adjust your numbers. And so now you think, well, how do I do that, right? And the how you do that is two ways. One, you use the offset function that's at the top, right? An offset function takes three arguments. One is where to start. The next one is how to move vertically. And the third one is how to move horizontally. So we just care about where it starts and how we traverse horizontally across the months. And so essentially in this, and so the question finally just becomes, how far do we move horizontally for the months? And the easy way that you figure that out is just figure out what's the ratio of months that's being moved. So in this Amazon example, you've got 45 days. That ratio over 30 means it's 1.5 months. And that means that I know that if you keep walking down the rows, that means that I'm gonna collect in month 1 and I'm gonna collect in month 2, right? And because it's 1.5, I know that 50% is gonna be collected in month 1 and 50% is gonna be collected in month 2. And you can see in this table to the right, I've exposed the Excel formulas. So you can simply just see, I took 45 days, converted it into 1.5 months, and then just used, I just truncated the 0.5 off of it and focused on the 1 as the month number. And then the remainder as, will tell you how to distribute the revenue amongst the months. So sorry, I know that was super confusing, but if you wanted to implement this in Excel, definitely contact me. I'm happy to help. And, but this should get you started as far as how to kind of implement these changes if you have an income statement in Excel that you're working with.
Or you could, if you do sell on Amazon Shopify, you can always leverage our product, which does this in real time. So that is the other option.
Yeah, that's Okay, so we talked.
That's a shameless plug.
Yeah. Okay, so if you're still alive after that dense slide there, so another reason why saving on working capital, as Robbie mentioned, and I love that he mentioned how when you save money on working capital, you just have more money for other things, and one of those things is running a marketing campaign. So this is actually another screenshot of not this of scenarios, and it's a feature that we're working on, but it'll allow you to easily do certain things like hire and fire someone in payroll, run a marketing campaign, adjust for customers that won't pay, right? If you look at your revenue, that's not how much money you're going to bring in. It's just not going to happen. You're going to have customers that are not going to pay. So you're going to have to take that into account in your cash flow. Adjusting for customer discounts. And then, as we mentioned before, adjusting for inventory purchases, because inventory you want to show up in January sometimes needs to be ordered in October or September, right? So now we're just going to dive into the marketing campaign. And again, this is just to show you how you can't look at your income statement and it tells you everything, right? So I'm going to walk through this timeline quick. And this is if you did a sample marketing campaign, right? And notice how when we talked about inventory, cash went out first and then came in later, right? Now you charge your credit card for, say, your Facebook promotion. So you preload your dollars into your Facebook, and then you spend that money over that day or series of days. And then the customer will respond and make that purchase, right? Then with Shopify, 6 days later or so, you get a $10,000 cash infusion, right? Now, just from doing operations, you have a positive cash balance for if it's 30 or 60 days, right? It's 26 or 56 days, you've got a positive cash balance, right? So that's one reason why the income statement won't show an interesting dynamic of working capital that's going on here. And then secondly, just looking at your income statement, you really see what's happened for the current period of time. And you can see how much someone spent in that current period. But those customers you acquired are going to make repeat purchases, right? So you may look at this and think 10,000 in, 10,000 out. Why even do this, right? But if you look ahead at how those people are going to behave from cash flow perspective, you'll get repeat customers who are going to come back that you're going to collect from Shopify. And this example actually maps close to a case study we're working on with one of our clients. But here you can see you got a lifetime value of 15K versus just 10, which makes for positive ROI. I mean, you would make, if you can find this arbitrage, you make this decision every single day. And that's really about what running an e-commerce business or any business is all about.
And hopefully you're advertising and not one-to-one. So obviously for the sake of the cancel, you probably spend 10K and get more than 10K, but this was just to show the value.
Yeah, this is my very simplified math. So just to wrap up, right? 82% of businesses fail to mismanage cash flow. We've got this stick figure tumbling down this treacherous stairway. So this is our shock and awe slide right here. It's saying that you need to adjust cash for timing for both inflows and outflows. Adjust cash timing. Revenue is not cash. Expenses are not cash. You need to make those adjustments so that you know where your cash stance is. Use your working capital to your advantage, right? Do all of those things Robbie talked about, like go down the list and make sure you're managing your payables, your receivables. Try to renegotiate some terms for your inventory, right? Use your working capital to your advantage, because it just means you have more cash in the bank, you have less financing for a buffer. It's just always, working capital is critical to be on top of. And thirdly, the other reason why looking at your income statement just doesn't give you the whole story is you always want to estimate the lifetime revenue of a customer and understand the ROI in your investments, right? It's not a current period thing. Like, you develop a relationship with these people. So your income statement is great, but it's just like, it's the first starting point, and it's extremely inadequate to determine whether your business is healthy, whether it's going to survive, whether you're delivering value, and whether you're running efficiently from a capital perspective. That's basically the takeaways of today.
So just to wrap it up, give you guys more time. I mean, the hope was that you guys got somewhat of an understanding of ways to leverage cash, extend cash, try to find ways to get cash in, where you're not feeling uncomfortable making investments in your business in times where the markets are down. Sometimes it's great most people tend to hunker down, but if you're able to do things and really reassess your business on how to make cash stay in your business longer, you should be able to reinvest those times. And then those times are the place that you grow the most. So the ones that survive tend to thrive once the market comes back. And if you're in a good position where you're just scaling can bring its own concerns, and growth can bring its own concerns, where you have to purchase more inventory. You have to make sure you are timing those right, so you're not pre-purchasing too much, where if something doesn't hit, that you're just sitting on inventory, not getting revenue back. So making sure you guys understand all the timings of cash is very vital to it. Appreciate the time. Thank you for everything.